After a week of extreme volatility on Wall Street, the worst we've seen in 2 years, the stock market is finally calming down. Thank goodness, right? Joining us this morning with a breakdown for investors, we have Ken Heisey here with the Heisey Advisory Group. Good morning.
Good morning.
How you feeling?
I feel great. It's been a wild ride so far this year.
Yes, it has. So right now they're saying that we are in a market correction. How are investors feeling? What do you think is the mood right now?
Well, typically the mood starts to get a little more toward fear when you have big drops like we had. We had a couple of days that dropped over 1,000 points. In fact, last Monday was the worst day ever in history in terms of the number of points the market dropped. But January, the market was up almost 7.5%. And in February, basically what we've done is given it right back. Year to date, we're only down about 0.5%. However, it's these big swings in volatile times that really start to put fear into people's mindset.
Exactly. So can you kind of break down a little bit, explain what is the reason for, these ups and downs, this turbulence? I think sometimes when you explain that, it does help diminish some of that fear.
Yeah, there's different indicators. There's some fear about inflation starting to creep up a little bit and how that might impact things. Then there's the Fed and interest rates. January, the Fed didn't raise rates, but there's a lot of talk that maybe March and maybe even 2 or 3 times later this year that we might see some interest rates go up, which then means the cost of borrowing impacts profits from corporations, and investors don't like that.
Right, and there's been this talk too of this bull market that we're in right now. Can you explain that a little bit?
It's been a wild ride. We've had 10 great years since the last great recession. And really what that's done is it's taken people from fear into that other emotion, which is greed. And the idea that this will keep going and going and going, and so greed starts to set into place. And what you really need to do is understand that when you have a great significant bull market, doing a reassessment, rebalancing, understanding the amount of risk that is now in your portfolio, because if you've grown excessively, you probably have more risk in that portfolio than you think you do. And getting an assessment on that would be a really important thing to do at this stage.
And just any other advice for people who are invested into the stock market, what they should be doing at this time? Because I've heard stories of people just completely pulling out or making several calls. I mean, are those really the right moves?
Never the right move to pull completely out, because you have to time the market and be right twice, when you get out and when you get back in. So if you're in your 20s, 30s, 40s, you've got a lot of time. Keep doing what you're doing. Keep investing regularly. That will win the race over time. But if you're getting into your 50s, into your 60s, if you're in your last 5 to 7 years before you want to retire, I'd start to look at pulling back, being a lot more preservation oriented with your principal. If you're still contributing, you can be a little more aggressive with contributions, but start to pull back, because if you have a market downturn that's significant, like we did in '08, you might have to work 3 or 4 years longer to recover from that.
Yeah. Ken Heisey, thanks so much for joining us here this morning. We've got more coming up here on Fox News in the Morning.